GDP growth for the world economy was still decent. And then it deteriorated quite markedly in the second quarter. And of course, on sentiment, but also on seasonal factors, strong first quarter, quite a bit weaker second quarter. Europe, debt situation still overhanging it, but also slower growth in the USA, slower growth in China. So a weak quarter, the weakest since the upswing started for the global economy. And all of that needs to be addressed somehow, and we expect some kind of policy action from the Fed, for example. So it's deteriorated, but I don't think it's as bad as we might think back to 2008. It's not that.
What is the lag effect of all this policy action? Because you mentioned China. China's had 2 interest rate cuts now, surprise interest rate cuts. We've got interest rates sitting at record lows in the EU, and also the question mark about quantitative easing in the United States. So what is the lag effect of all this stimulus action?
Yeah, of course, there's going to be a lag effect. The Chinese policy action thus far won't impact immediately. Although we must admit that some of those have started lifting up a little bit, money supply in China and bank lending in China. So there's already some move on the go in terms of real economic data. But I think any policy action that we might see down the line will have an immediate impact on sentiment, and that's important, and that might be more direct and immediate. US companies sit on vast amounts of cash. Profits are at historically high levels if you look at profits versus GDP. So companies, businesses, consumers can start spending immediately if sentiment starts changing in the right direction. So even though policy might have a long lag effect on the real economy, I still don't expect a fall down in terms of global growth as we had in 2008.
It's always that signal that is positive, of course. And as you say, market sentiment also very much rides on the back of question marks around more stimulatory activity. When it comes to the local economy, just looking at some of the data, consumer spending falling back to 3.1% growth in quarter one. That's versus 5% averaging in 2011. And business investment also falling back to 1.8% quarter on quarter versus 5.3% in 2011. What is your assessment of the confidence levels that we've got in South Africa with regards to consumers and businesses?
Yeah, they're also worried because of the European situation. Businesses especially are very focused on what's happening in Europe and the global economy. So their confidence level's not great, but it's once again not a fall down situation. Consumers looking a little bit better. We expected some slowdown into this year on the back of the higher inflation we saw last year, the somewhat slowing in consumer income growth. So consumers have been under pressure, but there are positives. We see consumers not collapsing. It's not a crunch situation like we had in 2008 into 2009. So consumers probably bottoming soon and starting to tick up. Business investment levels will probably start rising fairly soon. Very optimistically, we've seen that public sector fixed investment, general government plus public corporations, those investment levels on a growth basis have started picking up quite nicely, and I expect that to continue. So, yeah, not great for the local economy. Growth less than 3% this year.
Can the economy create jobs in an environment like this?
Probably not a lot, no.
Yeah.
Unfortunately. The SA economy hasn't created a lot of jobs. Even in upswing phases, it's been a slow creator of jobs. And we probably don't measure it correctly, but having said that, the economy is growing far too slowly to create significant amounts of jobs. Therefore, we need much higher growth levels and probably won't get there pretty soon.
So to what extent have we seen the global slowdown hitting the local economy? Where is it most evident in South African data?
Well, it comes through exports immediately, and we've seen that. That's why our own manufacturing PMIs have also collapsed because of the export impact, the expected further impact from Europe in terms of our exports. That comes through in the PMI, it comes through in the manufacturing sector. We've seen that coming through. So that's the immediate impact. And of course, then with the current account already in a big deficit situation, what happens when there's still positive terms of trade, that's relative export to import prices, when that's still very positive. But once that turns, when the current account is already in a big deficit, then serious trouble, because then foreign investors won't want to finance that anymore and the rand gets hit. That's the normal pattern in South Africa. And the rand collapses and interest rates will have to rise at some point. But I think at the moment foreign investors are far more focused on where can they get yield, return for their investment in this global situation where interest rates are going to be zero for virtually forever. Next 4 or 5 years at least.
Excuse me, sorry. Talk to me about the inflation. Guys, we're going to have to cut this. Oh, thank goodness it's not live. Sorry. US growth expectations have been declining. You've got growth sitting at 1.9% quarter on quarter in quarter one, and the expectation is for 1.5% in quarter two. And then you've also got concerns around the US fiscal cliff, expiration of those tax cuts. To what extent does this pose a risk for South Africa?
Well, let's start with the US real economic data. As you say, slower growth into the second quarter, also not creating the amount of jobs that they need to create. In terms of the fiscal cliff, I think that the probability of a fiscal cliff happening to the full extent, which is a plus minus 4% impact on GDP, I don't think that will happen. I think once again, at the very last minute, the Democrats and Republicans will come to some sort of agreement and some sort of deal. Fiscal cliff won't happen. So I don't think there's a huge impact on South Africa from the US economy.